Good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. I will be running through the major economic data points today, as well as a sell bias that's opened up in the Aussie New Zealand dollar pair. I'll just share the outlook for that. And we'll be looking at some of the major market dynamics which we've got on at the moment. A quieter day today in the markets with Japan and US away on holiday. So it is a quiet holiday thinned session, but we'll be running through the sentiment as well as what to expect with some pretty decent data points coming up. So FX should be well alive and looking forward to some potential decent trading events this week. If you can just let me know the usual, that you can see my screen and hear my voice a-okay, that will be appreciated, so I know that everything's coming through. Just as folks are coming into the webinar, thank you, Max. Don't forget that any entries, exits we talk about here, all of this will be from an educational perspective. Those of you who've been following these webinars for some time know that as we talk about different instruments, entries, exit, etc., it's not a signal trading service. It is a service where you look over my shoulder as a professional trader, see how I go about making trading decisions. These are the sort of key things we're going to be looking at: the euro, the pound, dollar, yen, discussing about BOJ intervention, as well as looking at global stocks, the major narrative that's been driving them lower over the last sort of 48 hours, and as well as what we potentially have ahead for gold and silver. We'll be looking at the US labour data that's coming, the UK labour data out tomorrow morning, and Japan will be back from holiday as well as the US. So we should see more volatility returning to markets tomorrow. Bit of a funny session expected ahead with the US away on holiday for Christopher Columbus Day. Without further ado, going to get stuck into the session. Got a lot to cover and I want to make sure we get through it all. So first, let's see what we're going to do first. I think first off, we're just going to run over the daily sentiment. So sentiment today is tilted to the downside. Now, if you just take a look at the data that we had over the weekend, we saw some disappointing data come out of China. Now, this CAC-SIN service is your private manufacturers, and you can see that both fell into contractionary territory. So that's a negative for risk. China is one of the world's largest economies, and US and China, between the two of them, make up nearly 50% of the world's GDP. So a slowdown in China is negative for sentiment. On top of that negative Chinese data, there was also news that the US would not be exporting certain chips to China. Some semiconductors would not be exported to China. That's negative for trade relations and general global sentiment. And we saw rising COVID cases in China, as well as an escalation of the Russian-Ukraine crisis, with missile strikes being noted across Ukraine, including the capital city, Kyiv. So we saw a more negative sentiment come into markets. And we've seen the dollar, one of the strongest currencies of the session, alongside the yen. CAD is stronger after that OPEC Plus decision last week, which has been broadly supported for oil markets. And we've seen the Aussie dollar, often traded as a proxy for the Chinese yuan, the weakest currency of the pack. The dollar strength has been pressurizing the majors lower. You just notice the pound US dollar and the euro US dollar. Decent hammer reversal bars in play there with the pound and the euro US dollar. Bearish close, long tail, and that would typically indicate lower prices ahead. Now, I haven't got into a trade here, even though technically this looks like selling. I want to wait for the UK employment data tomorrow. We'll run through that in a minute. Dollar yen, I just want to briefly cover that now. Now, with the dollar yen, remember the intervention from the Bank of Japan, 22nd of September, if memory serves me right. You can see here that big intervention. We saw all that yen strength. That was when the Bank of Japan intervened. Now you can see the dollar yen fell, 300, 400 points from that 145 region. We're back up at that 145 region now. Now this doesn't mean that the Bank of Japan is automatically going to intervene here. Remember, as long as 10-year yields keep pushing higher, and if you just see how closely 10-year yields track the dollar yen, let's just see if I can put this up as a, there we go. You see here, do you see the way the dollar yen tracks 10-year yields? Now this is so close as well because the Japanese bonds are capped by the BOJ. So the dollar yen just tracks this high, and as long as yields are pushing higher, they are, right, the dollar yen should push higher. So the Bank of Japan, they can't just bring this yield down by intervening in the dollar yen. It doesn't work like that. So they have to be responsive to what's going on in the global economy. And at the moment, prices favor the dollar yen keep moving higher. So if they do intervene, remember, you need to get it on a squawk, and you might expect the dollar yen to run maybe 300, 400 points lower, but you probably find dip buyers again, as long as current sentiment remains the same. Just be aware of that. Yes, the BOJ can intervene here, but the potential for that intervention to be successful is minimal. Swiss National Bank tried in 2015, failed. RBNZ abandoned it years ago when they were trying. The Bank of Japan tried it in the 90s, failed. It was some other market development which helped them weaken the yen. We also had the People's Bank of China mooting, keeping the dollar yuan 7 handle kind of pegged. They decided against it. So just bear that in mind when it comes to currency intervention. But that dollar strength, that's all been on that non-farm payrolls from last Friday. So let me just key you into that narrative. If you look at last Friday's NFP print, you see that it was pretty strong. Now, it wasn't the fact necessarily that the non-farm payroll was strong, but remember, the first indication that the Fed would really kind of need to pivot is they need to see inflation falling down, and they need to see labor data slowing. Now, this was good. Unemployment 3.5%. So that's a good unemployment rate. It's very low. And the headline was firm. 263K, only marginally below 315K from last month, pretty robust. And that just kept expectations that the Fed won't need to pivot. They can keep hiking interest rates aggressively. That's what caused stocks to fall off last Friday. So if you look at stocks, you see they fell off heavily last Friday, right? Because everyone thinks, well, the Fed doesn't need to pivot. That's the big narrative that you need to understand. Once you understand that, you understand one of the major narratives in the financial markets. How quickly, how aggressively will the Federal Reserve hike interest rates? If they do it slowly, you expect stocks to gain. If they do it quickly, you expect stocks to fall. That's the very simple rule of thumb. So that risk-off sentiment's in the markets, yields pushing higher as central banks are expected to hike interest rates through the coming weeks. And you can see stocks here just broadly pressured on the day, a little bit of upside in equity futures. Remember, US traders are away on holiday today. Expect very minor moves. And Tuesday, I would expect a reset in financial markets, and things should start to get going with freshness next on Tuesday. Now, one trade I have entered myself this morning is an Aussie New Zealand dollar short. Now, I'll show you the rationale for this. It was just pulling back into this resistance level. I sold it just before the webinar started. And what I'm looking, if you look here, can you see how the Reserve Bank of Australia, can you see that interest rate expectations have fallen after the RBA's meeting last week? Short-term interest rate markets now see the RBA being a lot less aggressive. They hiked by 25 basis points. Expectations 50% were they'd hike by 50 basis points. So we're only by hiking by 25 basis points. You can see investors and traders think that the RBA will be less aggressive going forward. The RBNZ also met last week, but unlike the RBA, they maintained a hawkish stance. Can you see short-term interest rate markets are remaining quite similar to what they were a week ago? Terminal rate expected to 4.87%. We also found out in the statement that the RBNZ board were debating whether they should have hiked by 75 basis points. So it was much more hawkish than many analysts have been expecting. That has opened up a sell bias in the near term in the Aussie-New Zealand dollar pair. Now just take a look at the daily chart. There's a couple of things for us to know. So first and foremost, we see the divergence between the RBA and the RBNZ. Look at the bond yield spread, that pushes lower. Now the yield spread tends to push prices along with it. So when the yield spread falls, so too does the Aussie New Zealand dollar. When the yield spread rises, so too does the Aussie New Zealand dollar. So falling yield spread, you would expect, and you can see that the yield spread's just broken down through its trend line, right? That's pushing lower. So it's reasonable to expect the Aussie-New Zealand dollar pair to keep pushing down, back down through its trend line. So looking for a break of that trend line to a move into that 1.120, 1.1180 region. So that's where I'm expecting prices to fall in the near term from that current market into this level, and stops can be placed above that 1.1375 region. So it does make sense from a risk reward perspective. You can just see that risk reward pretty reasonable, and if you just look short position, say from market, stops above the high, and you can see risk reward is not too bad. It is about 114 points, so you're risking about 1.65 risk reward from current prices. That makes sense on an RBNZ diversion. So that's a trade I've initiated. Again, not saying that you should take the trade. It's just outlining what I'm doing, so you can look over my shoulder, and it's that bond yield spread divergence. RBNZ should be more hawkish than the RBA going forward. Right. With that out of the way, we've covered sentiment. Let's now jump in to the calendar event. Now, this is interesting, and sorry about this, just my cat just choosing to make himself known. No data of any interest today, really. We might get some Fed speak, but we know how hawkish the Fed are, so we're not expecting any surprises there. The best opportunity that I can see coming up tomorrow is the UK employment data. Now, again, unemployment is low in the UK, so 3.6%. If it rises, that will be more negative. The best opportunity that I can see for this is if we have a big miss in the UK data. So I want to see a miss in the data to short the pound, and I want to short cable because I want to take advantage of that dollar strength. So this is what I'm looking for. Unemployment to rise above 3.7%. The claimant count to rise above 10,000, so about 20,000, 30,000. I want to see the employment change fall. So I want to see that to fall below minimum expectations, below 200,000. So I want 3.8% plus. I want 20,000 plus. I want minus 200,000 or greater. And I want to see average earnings above 5.9%. I want about 6%. If average earnings are high, that means inflation is high. It means inflation's got into wages. That's a problem. It will mean more aggressive interest rate hikes are needed. So a miss in the UK data tomorrow, and I want to short the pound. And I want to bear in mind with the pound that we've got this very nice hammer reversal bar on the weekly chart. So I could potentially look on selling that. Ideally, if we saw price retrace back up towards this kind of 1.1200 region, and I look for a short as close down as we get to that 1.100 level. Now, a lot of that is expressed in this dollar strength that we've seen on the pushback from the Fed pivot. Now, if we saw tomorrow the employment data was a beat and good, I'm not interested in trading it. I only want to trade it as a miss in line with the negative sentiment there is around the UK. We then have a number of central bank speakers. Need to watch out for them. They, of course, can impact their respective currencies. With the Fed, anything dovish is likely to influence markets much more than anything hawkish. The hawkish tone is what we're expecting. Fed getting tough on inflation, hiking interest rates, moving to that terminal rate about 4.5, 4.7%, anything like that is pretty much the base case now. Wednesday, industrial production, GDP data out coming. Now, again, if we saw another miss in the data here, I'd expect and I'd look to sell the pound US dollar pair again. So I wouldn't be looking to hold the pound very long. I'm only looking for a little scalp, right? But maybe 80 to 100 points low on a miss, and then I do the same again. If you've got a miss in the UK data on Wednesday, I would be looking at selling the pound US dollar pair again, because the dollar should remain supported on high core inflation expectations. We'll cover that in a minute. But if you look here, you can see that industrial production is expected to fall to 0.7%. If I see a reading below minus 2.7, if I see the industrial production below -2%, if we see manufacturing production month on month going below -0.7%, if I see a big miss across the board, below minimum expectations in those metrics, then that will give me enough reason to short the pound. If it's a good print, I'm not interested in them buying the pound. The balance of risk and what the market wants to do is sell the pound at the moment. So any reasons to sell the pound will likely result in pound selling. So you'd look at something like euro pound upside, but I prefer pound US dollar downside on a miss because of the US data that's coming up on Thursday. Got the WASDE report. Check out that if you're trading commodities. That gives you an indication what soybean levels are like, sugar, what the harvests are looking like for major commodities. So don't forget that's coming out at 5. Look out for commodity volatility potentially over that report. Then the most important data point of the day is US inflation. German data has importance. And the best opportunity would be this is misses lower, but we know that German inflation is expected to gain. German manufacturers have been saying that they're going to be passing on higher prices. We saw higher PPI print last week from the eurozone, so that should be high. A high reading is not unexpected. It would have to be incredibly high to get a reaction in the euro, so I'm not expecting that to be tradable. But if it's a big miss in the data, you know, year on year below kind of 10.5%, and inflation year on year below 9.5%, anything like that would be supportive, likely for the euro on a good data point. But I wouldn't feel confident in trading that because you could see the euro selling off on it as well. It'd be a bit of a tricky reaction. So I just hold fire on that German data, but the US data is much clearer, and there's definitely a tradable opportunity here on a miss. So what I look for here is, like, the higher inflation is, the more aggressive and quick the Fed has to be. The lower inflation is, the lower and the smaller reaction is needed from the Federal Reserve. So if we get the core inflation coming in below 6.4% for the year on year, so say it comes in 6.4, ideally 6.3 lower, and the headline comes in below 7.9, I'd expect immediate upside in silver and gold. Now, this is the trade I would go for personally, is silver upside. If you look at the gold-silver ratio, you can see that the gold-silver ratio is high. It's pushing above that 84 level. That means that silver is cheaper relative to gold. And you can see that silver is trying to find some support in this region. So any kind of big miss in the US CPI data, stops can be placed the other side of this trend line. So say at the moment, with the expectations of inflation to be high, that's been negative for silver and gold. I was selling silver and gold on Friday, had a nice couple of different ways of expressing that. Now, what I'm looking for here is if you see price move lower and then you get a big miss in the core CPI print, then upside in silver makes a lot of sense. Gold also is at a very nice technical turning point. So a big miss, and you'd expect upside in gold as well. I would be trading silver over preference to gold, but gold is a lovely little level. And if you just draw a trend line in across the top of that region, you can see that a nice retracement back up to that level. And if we broke higher through that, then that could be very attractive. And obviously, the lower we get, the easier it is just to place stops underneath that previous low. So that's the outlook really for silver and gold. Similarly, if we got a big miss in the inflation data, that should be upside for stocks as well, US stocks. Friday, inflation data out of China, nothing particularly tradable there that I can see at the top of my head, nothing that's springing to mind. US retail sales, again, the US consumer is responsible for about 70% of US's GDP. So strong retail sales is important for the sentiment around how the US consumer is feeling. That sentiment will be echoed or amplified by the US Mexican consumer sentiment detail that's out later. So what I want to see here, I want to see for the best opportunity. So say the headline inflation, say this is a big miss, okay, but say retail sales are really strong, then that should support the dollar. So you'd look to, fade whatever's happened on Thursday. If this is a really big miss, so we're talking coming in year on year, coming below sort of, 7%, the month on month is coming in below minus 1.1%. If we start seeing that sort of red across the board here, then you would expect the dollar to weaken, and I'd look for upside in US stocks, upside in gold. That's because bad news will be good news for stocks, because it means the Fed would need to be less aggressive. Then if we saw a big miss in consumer sentiment detail, again, that would be favorable for stocks. Bad news would be good news. If the Fed gets worried, the consumer is worried, then the Fed may slow down the path of interest rates, positive for stocks, negative for the dollar, positive for precious metals. So again, best opportunity will become on a big miss below expectations. So consumer sentiment below 56, current conditions below 58, consumer expectations below 55, anything like that should be supportive of gold upside, silver upside, and that should also be supportive of S&P 500 down, NASDAQ upside. So that's what I'm looking for in the coming week. I'm conscious I've really gone through quickly here, so make sure that you do check out recording, and you've got opportunity to ask questions if there's something not too clear. What do you think about the Aussie US dollar bearish movement, and will it continue and reach the March 2020 low? Okay, Suman, now the Aussie US dollar downside is because of a number of different reasons. So like today, my intraday bias is to sell the Aussie US dollar. If the Aussie US dollar got back up to here, I'd sell it at 6.370, 6.380. I'd sell from this region, the Aussie dollar. I'd have my stops just above the R2 looking for a low. Now, the reason the Aussie has moved lower is one, a more dovish RBA. Do check out my blog, blog.hycmlab, to see the latest on the RBA. If you haven't checking out or not checking out my blog, you absolutely must. I keep on top of it with central banks. So if you're looking to see what central banks have been doing, go to my blog here, Central Bank Watch, and you can see Reserve Bank of Australia, lower rates ahead. Answer yes, that's what markets are expecting. So I'm just gonna put this, just gonna try and, I'm not able to. Just trying to send this blog out to you, Suman. There we go. Sometimes this little box doesn't work very well for me, so just seeing if I can. Yeah, I've got it. Right, so I've got it to the handout there in the chat box. So that's why the strong non-farm payroll supported the dollar. The more dovish RBA weakened the Aussie. Also, we had that Chinese CAC-SEN data out, Suman. That weakens the Australian dollar, because Australia is a big trading partner with China. Anything negative for China is negative for the Aussie. We've also seen COVID cases, rising again in China. All of that supports the Aussie US dollar pair. Now, you've asked me a hard question, which is, will it continue to reach the March 2020 low? Now, one thing I can't do is I can't tell the future. Okay, so that's very hard for me to say. Will it reach March 2020 low? That is hundreds and hundreds of points away, and there's a lot of time that takes place between now and then. So what I can't tell you the future, but what I can tell you is where you can define limit risk, what you can look at in terms of what you expect. If like the inflation data comes in really high, and if China's data continues to be bad, and the RBA continues more dovish, yeah, there's no reason why the Aussie US dollar can't keep tracking lower. I've got a sentiment to sell the Aussie US dollar today. Any retracement up to that region, suitable for selling. Stops above the R2, looking at taking profit around that 0.6300 region. But the path of the Aussie US dollar is tilted lower as long as the Fed remains aggressive in hiking interest rates. If the Fed suddenly pivots, Suman, and they say we're going to slow down the path of interest rates, the Aussie US dollar can easily gain and shoot higher. So in these kind of markets, you need to look at the near-term direction and the near-term narratives to take the trades. And that's exactly what I was doing last week. On Monday, I was trading the Fed pivot, upside gold, upside silver, upside stocks. And on Friday, I was trading the pushback against the pivot, downside silver, downside gold, downside stocks. So Suman, there's no point in my bit trying to predict the future and trying to speculate, will the Aussie US dollar keep falling all the way down to March lows? Who knows? It's very hard to tell you, but what I do know is what would it need to do? You need to see worsening Chinese data. You need to see very high inflation. You need to see an aggressive Federal Reserve. You need to see falling commodity prices. You need to see falling stocks. So I hope that helps, Suman, to realize that predicting the future is not what trading is about. Trading is about seeing that tradable edge. Where can you define risk? Where can you limit risk? How can you take a trade that makes sense? Okay, just a bit like with the Aussie news and dollar I started. Yes, I've got my bias. Yes, I'm expecting price to fall into this region here, but I've got my stops just above that 1.1375 region. So if I'm wrong, I'm stopped out, absolutely fine. But I know where I'm looking for the price and the trade to go. So I hope that helps. Folks, wow. I don't think I've spoken that quickly for quite some time, but you can always listen to the recording and listen to it at half speed so that you can get all that detail that I crammed into our session. It's been an absolute pleasure. Don't forget, we'll be back on Wednesday, and I will be showing you how exactly I'm trading that inflation data print, and I'll be showing you the best currency pairs instruments that I'm looking at. And don't forget to come back here on Wednesday. I will be around for the 12:30 UK time, 1:30, and we'll be looking at the US inflation print. And that will be a really crucial one. It's the main economic trading point of this week. It's the one trading point you don't want to miss. Take care, everyone. Thank you all very much. Been a pleasure, and I hope you have an excellent week. Yeah, thanks, Max. Take care, everyone now. Goodbye.